The cost of construction is a big risk, and then how much traffic is going to use it. But once you have 2, 3, 4, 5 years history, traffic doesn't vary very much, and the government regulates the toll, so it goes up by inflation or inflation plus sometimes, and putting the toll up generally doesn't affect the traffic all that much. So we haven't really seen big dips in traffic apart from COVID. I mean, COVID was certainly one that put the quality of infrastructure assets to the test. So when your traffic falls 20% on your toll road, your whole operating system is going to struggle.
Yeah, the revenue is going
your
to be...
airport closes to all intents and purposes. People stop riding your train. But that's a very unusual, that's very much a black swan event. Overall, over time, infrastructure is a remarkably stable revenue stream, generally indexed to inflation or GDP growth, and the operating costs are very low. So the cost of operating a road or a tunnel once it's built are very low. You've got to collect the toll, you've got to keep the fans running. There's not a lot of work, so your operating costs tend to be 10% or less of revenue. So the big thing that drives your profitability is the cost of your capital. So structuring your, what we call the capital stack, so equity is the most expensive piece of that. That's the bit that listed on the stock exchange. Then you have various levels of subordination on the debt, and the senior debt, which is the stuff that gets paid first, is usually very, very cheap. And so the biggest competitive advantage for a infrastructure operator is generally their cost of capital. And so
why is that? Is this the money that they're borrowing from banks?
Yeah, so if you think about my toll road example, if once you've built it and you've spent your $1 billion,
give or take,
the operating costs are very low. So what's the thing that drives your profit? It's interest payments on this big debt that you've got. So shaving a couple of basis points, that's hundreds of a percent off your cost of capital, makes a huge difference to the profit. And so quite often you'll see infrastructure assets going through refinancings, and Transurban's got a big one coming up. So usually that's a sign that profits are going to go up as they refinance at a lower rate. Revenue's higher, it's more stable, you've got a longer history, and you should be able to get a better deal on your debt. Problems can arise, though, if you have to refinance at a time when markets are tight or interest rates have gone up. So you might find that refinancing a 5-year-old fixed rate debt is now going to cost you more. So if you're investing in infrastructure, you need to look at the balance sheet and you need to look at the timing and structure of their debt packages. That's what makes the difference.